Well, Amanda has a great question. She's got a borrower who has 4 years financial statements submitted, and over that period of time, write-offs of inventory are escalating from 60,000 in 2011 right along up to $605,000 by 2014. So the account officer wanted to actually add back that adjustment to come up with recurring cash flow, and she's wondering if that's reasonable. Well, first of all, yikes, that kind of escalating write-off or write-down of inventory over a 4-year period gets my attention and raises some additional questions. But first, let's talk about some simplifying assumptions we make about cost of goods sold, why you might write down inventory, and then in this particular case, what additional questions this all is raising. So first of all, cost of goods sold, simplifying assumption. Generally, we just make this assumption that cash flow from operations is available to pay debt and to pay the owners. That said, though, when a business is growing, in fact, some of it is being used to buy the new working capital, increase inventory. So the simplifying assumption holds as long as their beginning in inventory is relatively stable. But if inventory is going up, then often some of their cash flow generated by operations is needed to push it up. And on the other hand, if inventory is dropping and it's not because of write-offs or write-downs, then that's freeing up some additional cash flow, at least at that point, to pay debt, pay the owners. Now let's talk a little bit about inventory and why it might be written down. Two reasons. One is that some of it's obsolete. So they have to write it down to more accurately reflect their inventory levels and the loss of that year. The other reason for write-downs is that the value is dropping. They could buy it cheaper now than they paid for it earlier. Those two write-downs are typically showing up in the cost of goods sold section itself, or if they're really significant, sometimes they show up right in the expenses in the income statement. Again, if it was just a one-off, if they did 1 year in there, they had to write some down and otherwise profitability looks good, I might be inclined to add it back as a non-recurring item. And there's even sometimes when an inventory write-down could be non-cash in the period of years you're reviewing. So let's say it was towards the beginning of that 4-year period, and this is inventory they'd actually bought previously in 2010. Well, then the write-down in 2011 through 2014 isn't related to cash that was actually spent out of pocket those years. So I could be talked into an add back on these if I thought it was non-recurring or non-cash. However, this is 4 years in a row and it's escalating. So I had a whole nother set of questions. I was curious about what's happening with their revenue levels. What kind of industry are they in? And did that whole industry take a hit in that 2011 to 2014 time frame? If so, are they recovering, and what's the indication for that? Now, it was nice. Amanda then followed up from my questions and gave me a little more information. Their profitability, actually, their revenue is increasing. Profitability is fairly holding except for those write-downs. They've got really good collateral that's very liquid. So they're comfortable with their position. They just wanted to understand this one better and decide what they should do about the cash flow calculations. So there you go. I've got some online modules on our Lenders Online training site that's very much on point for this. One on balance sheets, one on an introduction to analysis that has you asking the right questions, and then one on the loan proposal and your write-up. So there you go. Lots of write-downs. Great questions, Amanda.